Saurabh Mukherjea, founder at Marcellus Investment Managers, is joining us on the show. So, Saurabh, thanks very much for this last-minute accommodation of our request. The market, again, extremely difficult to gauge the direction. Structure still remains weak. You sort of started to see some stability last week, but that's, put to the back burner once again. Your approach, you've stuck by your quality names, essentials, we've spoken about that. But is there anything else that one needs to factor in now?
I think the picture remains relatively clear, as I've been saying on your show for several months, Lavina. We are in a economic slowdown. We're not going to come out of it, in the next three or 6 months. I reckon the quarter to September, the growth rate will be even lower than it was in the quarter to June. And over and above that, we've got a financial system which is in a mess. Again, I don't see any easy remedies for that around the corner. I reckon the situation in the financial services sector will worsen further before things start looking better. So with that regard, the macro picture has been clear for a while, remains clear that we are in a very difficult macro climate, and that's why every opportunity you've given me, I've reiterated our point of view that buy consistent compounders, high-quality, cash-generative, well-run companies, and you'll be able to get returns in the mid-teens through this difficult period for the Indian economy.
Right. Saurabh, if I were to just shift focus to companies with a market capitalization about 10,000 crores to about 75,000 crores on the top end, maybe some of these companies are likely to grow and have grown at the rate of around 15 to 20% over the past 3 to 4 years. But there is also the case of valuations. Are you seeing any significant correction in valuations now that you would like to start nibbling into? If yes, what are these areas?
So I think one of the things to keep in mind is I think we misunderstand how valuations work in India. For, I would say, 80% of the Indian stock market, earnings growth has been close to zero for the last decade or so. So if a company barely grows, obviously it doesn't matter whether the PE multiple is 6 or 16 or 60, you're not going to touch it. There is no earnings engine there. Then for around another 8-9% of our markets, say companies like Maruti or a Unilever, earnings over the last decade have grown at 10-11%. And of course, if a company's earnings grow only at 10-11%, you worry about buying these companies at PE multiples of 30, 50 or 60. But for around 20-25 stocks, around say 1% of the BSE 100, 1% of the BSE 500, we've seen consistent ability to chug out 20-25% earnings growth. And if you focus on this 1%, we've published a lot of material to show whether it's 30 times, 40 times, or even 50 times, buying stocks which are chugging out 20-25% earnings growth, even if PE compresses materially, you end up making mid-teens returns. So if I take my own portfolio, earnings growth over the last 6 months or so has been 17%. PE has come off a bit, and as a result, 17 minus PE compression of 3-4%, our portfolio is still giving 14-15% returns through this difficult period. So it's really, really important to understand the underlying strength of the earnings engine. If you don't have strength in the earnings engine, which is true for 80% of our companies, it doesn't matter how cheap you buy, you're not going to make money in an economic boom or a bust. And the reverse holds true for compounders like Asian Paints or an HDFC Bank or a Marico. The earnings engine is so strong that even in an economic downturn, even with PE compression, you will take home mid-teen returns.
Saurabh, at what level on the index do you feel that you'll start worrying? Because at this point, even if there is a marginal correction, not too many people seem to be perturbed. But if you do see things going slightly wrong in a way that other variables across the globe don't pan out as per plan, this could worsen. And then at what level do you get worried?
So I think on the index, I was worrying 2 years ago. I was worrying on your show 2 weeks ago, right? I said again on your show 2 weeks ago that I reckon the Nifty was around 10% overvalued. So the index has been in a worrisome position in our country for a long time now. The valuations of the Nifty have not justified the inability of the Nifty to show double-digit earnings growth for 6 years now. But the reverse holds true for a company like Asian Paints or a company like say Pidilite or a Dr. Lal Path Labs. And I confess, in all of these cases, these are in our portfolio and these are my own personal holdings. The reverse holds true there because these companies are selling daily essentials. These are products that you need, whether it's an upturn or a downturn, regardless of what the global macro climate is. You need to get your blood test done. You need to feed your child baby milk. You need to cook your food in varicose oil. You don't have a choice, right? And as a result, even through the downturn, your earnings growth is chugging through at mid-teens, sometimes early 20%. And over and above that, their monopolies are very, very strong. So whether it's Nestle in baby milk, Asian Paint and Paint, Dr. Lal Path Labs in the northern and eastern landscape. So it's really central to understand the robustness of demand for daily essentials. The robustness of demand is considerable. And secondly, the strength of the monopoly, the barriers to entry. These franchises that I'm mentioning, the barriers to entry are very, very high. So that protects your margins. Your revenues are protected. You obviously look for clean governance, clean accounts. So clean accounting, steady revenues, robust margins. You're de-risking yourself in many different ways, and thus you're allowing yourself to earn considerable returns, mid-teens, high-teens returns, even in a downturn, whilst crushing risk in a pretty fundamental manner. It's central to be able to invest in India like that, otherwise you lose a lot of money very quickly.